This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covell. Not filtered, raw, honest. That's my passion. My guest today, Jerry Parker, one of the original turtle traders trained by Richard Dennis. For those of you that draw a blank when I say that, you say, I don't know what that means, Mike. You are speaking Morse code, some type of language that disappeared eons ago. That means you have not yet read my second book, The Complete Turtle Trader. Pick that book up immediately. Yes, it's not going to break the bank or anything. It is the true story, absolutely true, a freaking Wall Street legend story of brand new, essentially no experience students, I don't know, ages 18 to late 30s, taken off the street, given rules by one of the most successful traders of all time, Richard Dennis, given rules and said to those students, take these rules, and they were trend following rules, take these rules, go trade, and let's see what happens. Well, they made a lot of money. These rules, these foundational trend following rules that the turtle traders learned, turtle was a nickname. Trend following, just trend following, the base strategy that every type of trend following trader you can imagine would use to this day. Now, there's going to be different wrinkles here and different wrinkles there and different portfolios here and different leverage choices there. But foundationally, trend following, and that means the trend following that the turtle traders that my guest today, Jerry Parker, learned, is really based off all of the work that guys like Daniel Kahneman and Amos Tversky figured out, that human beings are crazy. And when it comes to their money, greed and fear dominate. So if you know that greed and fear dominate, how can you take advantage? Boom, that's Trend Following 101. That's where it starts. So my guest today, Jerry Parker, one of the first original turtle traders. And boy, has he had crazy success over his 4-decade career. I know people like to say, oh, this strategy or that strategy, it goes away. 4 decades? Give me a break. And Jerry's not an outlier. There's plenty of people out there, plenty of trend following traders with these multi-decade track record experiences. It's just an amazing story. This is not Jerry's first time on this podcast, but I love having him on. He gives a very down-home perspective. He has a very, very straightforward way of breaking down and explaining how it all works. And we can learn from that. But you really have to start. If you have not, most people have, you really have to start with my book, The Complete Turtle Trader. It really gives a foundation. And for those of you that don't know about this, The Complete Turtle Trader came out in 2016 with an audiobook. And that audiobook has a special interview, a special behind-the-scenes interview with Jerry, beyond the podcast today, but a special interview on the audiobook of The Complete Turtle Trader that is only on the audiobook. So I really implore you to check that out. I think you'll enjoy that as well. Without further ado, let me jump into my guest today, Jerry Parker. I hope you enjoyed this episode.
The end of trend following, I kind of doubt it. There's a lot of people who criticize trend following. Once again, I'm pretty shocked at how they need my help to articulate why it might not be working and how it might fail. I don't, the lack of understanding basically how it works. I have no problem with someone using logic and saying, okay, I think we're at the end here because of the false breakouts in the crashing markets. And then I would respect that. But a lot of the criticism comes from other people who really don't really understand what it's all about.
That gets at kind of my bringing up Kahneman's perspective, the thinking fast, slow, which, the kind of prospect theory, behavioral work. It's like, has human nature changed, Jerry? Look, there's been drawdown periods in the past. There'll be drawdown periods in the future. That's the nature of trend following. You're always kind of like, you get to a high water mark and then it's a drawdown again. That's kind of pretty typical. But has behavior changed? Because I got to tell you, when I look at these cryptocurrencies, it looks like 1980s commodity markets.
Yeah, but you can't just pull out one market and say, oh wow, trend following works. It's really all of the markets, and the more markets we trade and more diversification we add to our portfolio, the better. And yet each market is worth less and less. You just can't really pull out one group of markets and make and say, well, this proves anything. But yeah, I just think that taking small losses is tough for people. Sticking with the trend and not getting out too quickly is tough. It's tough, psychologically tough. The whole trend following equation, is sort of tough because not as tough as it used to be because so many things are quantified and computerized. Still, it doesn't matter. All the people out there who are trading it incorrectly and properly by taking large losses and getting out their profits quickly, we ourselves, CTA community itself, can destroy our business by everyone getting in and doing the same trade at the same time in large quantities without regard to the liquidity. And when I used to trade over 2 billion, I would watch some of the smaller markets move around, and it would be unsettling to see some of these big moves in cocoa, but it was never me. I was buying 5 lots at a time and just taking a day or 2 or 3 and just understanding that it did me no good to indiscriminately throw on a big huge trade because I was just going to get a horrible price back. I think the sort of people who are large CTAs need to sort of get together and talk about these things, like how can we not cause so much trouble in the markets, because it will come back to harm the industry, because another period of Dow down 1,000 will be better investigated the next time as to what people are doing and who's doing it.
Just to clarify also on diversification, I often get questions from folks that are asking about kind of one market in isolation. I'm like, well, I don't know how one market in isolation is a trend following trade come from, where your profits might not come from. But you can have different big trends in different years, and your profits could come from those. I guess that my point with bringing up Bitcoin is it's one of these great, behavioral trends. Tulip mania, it might go a zillion times higher. But I think with it not being a market that is freely liquid in the way that you would think of as freely liquid markets, it kind of probably is not a positive thing for trend following traders to look at that as outside of their portfolios, because it's a massive trend.
So that's the great thing about the systematic trading that I've experienced over the years is when a new market comes along like this, hopefully there'll be many more in the future, you're an instant expert. You just plug it into your system, you collect the data, historical data, you're trading every market the same way. Your longs and shorts are traded the same way. So you need to understand the correlation aspects of this new market, and then you put it in there, and then you own it. It's yours. I've done that many times where a brand new market had a big trend right out of the gate, and I made a lot of money on it. It really is nice that we are probably going to see a lot more new markets over the years.
But what's funny is that you're quite well known for some quotes that I've found of yours over the years that I've just loved, where you've talked about applying your methods, your trend following methods, to markets that people would never expect. And why not? If there's a price there, you can trade it. I mean, look, a lot of different people will listen to this podcast, but the idea that you, Jerry Parker, with a system can allow yourself, your firm, to be an expert in a market that you might otherwise not have any fundamental knowledge about, for example, a Bitcoin or Ethereum or something, and that you could go in and trade that successfully, given liquidity and whatnot. That's a pretty amazing concept.
Yeah, well, I'm not an expert in any of these markets, so it's a great concept. So maybe we give up a little bit by not relying on our experience or our gut feel. I doubt it. We don't probably want to do that. We want the systems, execute these systems without regard to all of the things we've quote unquote learned over the years. So that's pretty amazing. And then when you do that, you have every liquid market at your disposal. You create a very safe portfolio. Long, shorts, it's really just an amazing thing. But we just need to have a preponderance of large moves and trends. But if you only traded stocks like most of the world, and that was your whole portfolio of markets, then there's been times where stocks have not performed. Obviously, 2008, the lost decade. It's painful, it's not fun, it's not good, but I really don't see an alternative to systematic, long-term diversified trend following. Which one of those are we going to give up? The systematic piece? I don't think so. I don't think that's the way to do it. Not diversification, not the long-term piece. We're going to start taking large losses and take small profits. It's still the best thing we can do. We're still churning water, preserving capital, and really just focusing on the fact that I think this is one of the cornerstones that I try to tell people all the time, is that stock trends are not superior to other trends. Now that is really crazy talk right there, because it certainly does look like
that's
it.
Deep, and that is something that goes right over people's heads.
If that's incorrect, then oops, my bad. But I'm pretty sure that 2.5 years is not enough.
Why don't you elaborate on that? Because what you're really saying, and I think is worth, and the same as a trend to Tesla. I mean, all other things being equal, the same price move, and that just doesn't register. Hold on, coffee, but Tesla's so cool.
I think that people do believe that the stocks just have more big moves. They're always trending. They have been very good at different points in time, but so are the commodities and the currencies and bonds. So I don't really see any evidence that the stocks are inherently superior or what's worth trading all of your money. You've got to get Eric Crittenden back on your podcast, because he shared with me a research that he did about stocks, and it was absolutely amazing research. Because at the time we were talking about the sort of popular news articles that have been out about how 4% of stocks account for all of the profits in equities. And over the years, this a small percentage of stocks make all of the profits. Most stocks don't make more than the treasury bill rate. Lots and lots of stocks don't make any money, they lose money. He shared with me this research that he had done where he had just looked at stocks that were no longer in existence. They had gone out of business, they'd been merged, they were the missing stocks, and he used a trend following system on those stocks, and they virtually made about the same amount of money as the stocks that were still around. So trend following rehabilitates and changes all the statistics of the buy and hold in markets. So here you had the worst stocks possible that didn't make any money, that went out of business. They were good stocks to trade. Trend following is definitely a mandatory part of every portfolio and hold mentality. And yet they at the same time do agree that momentum works, and there's too many academic papers out there to disagree with that. But when putting the two together, it's hard to bridge that gap.
I would tell people, and I'll remind people at the end too, that if they want to come into your world and find out what you're interested in and your views on current happenings, your Twitter feed's a great place. And I told you in advance that I was going to kind of go through and pick some of my choice nuggets, because you can get controversial on a podcast, but you get really controversial on Twitter.
I think that's the place to do it, and in a nice way. I mean, I learned some stuff on Twitter. I've been wrong before. I know you find that hard to believe, but it is kind of fun and intriguing to play around with Twitter and to learn from a lot of smart people.
There's a line that I caught on there, just kind of a lead up to. There's a line that I love that I would like for you to explain to the audience, and it's just something that I pulled from your feed. Value investors are the real speculators. That's one of those controversial type statements.
Well, I'm pretty sure that's just a quote from the Wall Street Journal article.
Well, yes, but you're a master at pulling things and just leaving people to think through, why did Jerry pull that and put that there?
Yeah, well, I guess I'm saying the answer is in that article, but I know obviously that's kind of an easy one, and maybe I'll twist that to what I really believe by that, which is, it doesn't get more risky to carve out one sector and decide I'm going to trade with one sector. Then don't be surprised if the average return is 7 or 8% with a drawdown greater than 50%. It's just amazing how when you add currencies, commodities, and bonds to that portfolio, long and short, how it makes life so much better. So you may make the same 8% return, let's say, but with a 20% drawdown or half the drawdown possibly. So it'd be difficult to be in, maybe did some shorts as well. And then I guess the value of trying to pick bottoms and buy things that are going down and is a little scary, the trend following of small losses and paying attention to price only. And if it goes against you, by definition, it's a bad trade and you should reduce your risk. Versus the opposite of that, if it goes against you, it's a better trade. Now let's buy more. I think it's difficult to see that that's kind of a risky thing, but it's always worked and it works. Okay, that's good. But the world's always changing, as you just said, and things that never happened before are happening. Value is in this big decline, and from a money management point of view, you can see how that could really spin out of control if you took it seriously. Sort of the opposite of trend following is something I would want to stay away from.
Why don't you speak also, and this is one of these nuggets that I also pulled from your Twitter feed, I think the body of evidence, and I'm not sure if this is a quote directly from you, but I think the body of evidence would favor trend over value for crash protection. Now look, I already can see people as I start to talk about a quote crash. Some people have already tuned out and they're already saying, well, Mike is talking about a prediction. Now he wants Jerry to talk about a prediction. Not at all. But the whole thinking of having this system over this widely diversified set of markets is such that when you have equity markets taking it on the chin, and they'll take it on the chin at some point in time in the future, there's a crash protection in this trend following strategy that's very unique and it's very cool.
Yeah, it's not going to work all the time or every time. So I think it's two different pieces to that. One is humbling yourself and paying attention, submitting your ideas to what's going on with the trend. And so putting yourself in a situation where the mere fact that it's going down and you're long, you're going to be defensive. You're going to reduce your position or you're going to get out and you're going to be looking maybe to get short. The way trend following works, it is going to help a lot there, and then you're not going to try to find a bottom and look at lower prices as a bargain. So let's hop in now that it's a bargain. And then again, it's back to diversification, that even if you're sort of caught with a bear market and you didn't get out in time or get short in time, you still have a lot of other markets to look at that will offer some level of diversification, hopefully. So it's really a defensive, conservative way of managing money. Now, over the years, I think I could be guilty of using too much leverage or making it look like it's not that safe, but in essence, it's a pretty safe way to manage your money.
Risk of ruin is not something that I think is probably on the lips of the typical passive, stocks-only, long-only mutual fund manager, whereas
Watch
risk of
out,
ruin is
vehicle stopped on shoulder ahead.
in the early 1980s.
But that's right. It's nothing more important than being around to play and to preserve your capital. I think it doesn't go without saying, because it needs to be said that there's little that's more important than the proper choice of leverage when you first start out. You don't want to get into this with higher leverage that you can't live with. That's going to make you not do the trades you need to do. That's sort of the secret of all of this. Do all the system trades all the time for the rest of your life. So you don't want to get into a situation where leverage prevents you from doing that frequently. And sometimes, no matter how good the system is, you can Monte Carlo it to where it's going to show a drastic drawdown. So you need to have another rule in place, which is that when you hit these levels of drawdown, you reduce your leverage, reduce your positions, reduce the size of your future trades materially until you sort of continue to do that as you lose, so that you can preserve your capital. So I'm just sort of saying that you can't fall in love with these systems. You've got to exercise some methods out of the system, reduce your leverage. So if you're down 10%, reduce your leverage by 20%, and reduce all your future trades by 20%. So reduce your leverage and your risk quicker, fast. You make your risk of ruin or your risk of getting into a certain drawdown level that might be ruin for your business less and less likely. So no system is immune to that. But once again, I've seen people run these numbers and say, risk of ruin is too high, it doesn't work. And I would sort of agree with that. Their agenda was to trash trend following, but yes, it's absolutely true that these are not religious experiences and things that you can rely upon. You need to preserve capital, reduce your risk, and do whatever it takes to stay around and keep your money, keep your assets under management. If you continually trade too large and your average profit each day is 2 or 3% profit or loss, and then you're going to get yourself into having to frequently do these risk adjusting trades, and then you're sort of not able to follow your system.
Yeah, Jerry, I had a lunch today with a young guy around 30. He's had some success with these ICOs and Bitcoin, and he doesn't have a strategy other than the fact that as many people in this age bracket that I've talked to that have been investing in Bitcoin or buying Bitcoin and some of these ICOs, they're just getting in without a real strategy. And look, this is your 4th decade of watching markets, watching behavior, talking to people constantly. Is it interesting to you to watch the latest generation going through their latest kind of first market forays and the latest big trend run? I think when I look at something like trend following, I look at human behavior, and people wonder, why will trend following continue to work? Well, it's like, when are people going to stop being people?
I'm not really well versed on this Bitcoin. I do think it's kind of fascinating, and I do like the idea that there is something that you can invest in that a computer generated, and it's not really a currency, but it's just something to invest in, like gold maybe, and hopefully it all ends well, and it does become something that's safe and stable and a mutual fund, and people don't lose their money. But I do think it's very interesting to watch, but I really don't understand it. But I don't really understand soybeans either, so I act like I do, but I probably really don't.
I wish we could see your face as you're saying this, because I think you're kind of like just you're saying to people, hey, look, I'm a trend follower. Like, yeah, Mike, I can go down the path with you and I can speculate about the foundations of some of these market moves and this and that, but I just don't know. And by no means are you trying to pass the buck or say I'm not being wise about my investments. You've just got a very consistent, and I think a fair word for a trend following trader is it's a boring strategy. There is no, Jerry Parker doesn't sit down and lock himself into a cockpit chair every morning with 15 monitors in front of him, with IVs of juice into your arms for whatever reason. I mean, that's, I don't think people even have I remember walking into your office for the first time in Mannequin Sabbath. I thought I was in a law firm.
Yeah, it kind of was a law firm, but we rented space from, but yeah.
It's something that still, even though you're in the middle of this, you live it, you breathe it, you give some examples about how CTAs are perhaps crowding out trades and stuff. But I think if you and I were to take a random sampling of 1,000, let's say, doctors and attorneys, what percentage of them would really have investments in trend following or even know about the basics of trend following?
That's a good question. I think they know the basics. I'm not sure how they don't have more of investments in trend following. I think everyone kind of understands the basics. And that, 1981 or so, I read about trend following, read books and newsletters and magazine articles and things like that.
How are we equating you to just the regular guy? I'm not saying, you are a regular guy, I get that, but you've kind of gone down a certain special path when it comes to trend following.
Yeah, but even before I got started, I was an accountant in 1981. I was learning about it. I thought it was wonderful. I thought it was great. I understood exactly how it could work. And basically, it's, do these small losses, do the big profits get paid by this? Do you have enough big profits to pay for the small losses? And I instantly liked it and thought it was great. I'm a little skeptical of people who don't invest because they don't understand it or they can't like it. You got to like it. There's nothing not to like. It's absolutely wonderful. With the diversification, the risk control, and the equation, can 60% of the losses be overcome by 40% of the winners? I think once we have another bad period for traditional assets, then people become instant geniuses and experts on, oh yes, I know exactly how this works. And I think it's just a matter of time before it comes out that people are more. And I'm always reading about how the CTA industry is growing. There may just be a few people, but I do think people instinctively understand exactly how it works and how it could help them. The more this bull market goes higher, people are fairly skeptical, I guess, and understand that other markets, gold and currencies, that's some things to look at.
You're 4 decades into following trends. Can you remember any trend, any market where, maybe there were some, but can you remember any point in time where, the market was going one direction and maybe perhaps a nice, steady one direction and then went the other way? It's always a surprise, isn't it?
I think so. I can remember sometimes where it wasn't a surprise and I was like totally dumbfounded by it. It can happen where people are, talk about a trend ending and it does happen. I would just say that's one of the lessons is that any pattern and set of circumstances you can imagine will happen eventually. It just shows we don't really have a lot of data, enough data to sort of know exactly what's going to happen in the future. Maybe if we even had a lot more data, we still probably couldn't predict what some of these patterns would happen. But I'd say by and large, it's much better to get into a trend where the market is the fundamentals and the news is one direction and the trend is another. I've definitely seen that on some trades I've been in after some long-term trends where the market got bullish news. It should have continued strong, but it reversed. And so that's kind of another, I think, a good discretionary move that we were sort of taught to pay attention to the trend so much and only the trend. But then if you did get some sort of news item that seemed counter to the trend, and then maybe that would be a fun spot to play around and just do a 10% discretionary move. So that was definitely part of the turtle story that I don't think is told a lot. The sort of contrary opinion, fade the news, fade the news, fade your friends.
One of the things that I grabbed from your Twitter feed that I liked, and I've seen this in different incarnations over the years, I'm kind of paraphrasing a little bit here, but you were talking about the idea of kind of a back of the envelope algorithm, something simple, so to speak, and you were kind of contrasting that with those folks that have the view of this optimal or complicated formula, or they have this expert judgment. The idea of simple alone causes people to discount it. They don't see that there's so much goodness about simple applied consistently versus those folks that think they can find this optimal supercomputer, something or another that will guide them. The simple gets kind of discounted and not accepted.
True, I think that's true. I think another thing to emphasize on that statement, which I got from someone else, which is a link on my website to the actual person who said this. I don't remember who said it, but I think just, first of all, choose the algorithm. That's the big one right there. Simple is good, but choose the algorithm. That's going to help you. So be a person who is prone to rules and following rules and understanding the power of these rules. So number one, right out of the box, you got to choose the algorithm. Now we can move on to simple or not simple, but really that's the fundamental foundational idea. Please choose that system. The consistent application is going to, more than likely for most of us, overcome the discretion. I think that really at the heart of this, and this just doesn't get talked about enough, but if you go back and listen to our podcast, I mention it every single time, is why the simple algorithm or why the simpler is going to be more powerful. It's really because of the sample size. The more you add variables and try to find just the A+ trades and the perfect system that enters and exits and does 5 trades a year or 50 trades a year or whatever, you're just going to lose a lot of sample size and of historical trades. And so it's going to be a weaker system because it's fitted to the past, maybe not as much as it needs to be ready for anything in the future. I had a friend who told me the other day that he traded some systems that didn't really work that well in the past. because he wants to be ready.
Straight for 20
There's still
minutes
trend
to
following, let's say,
I-10
but
West,
he
Santa
doesn't care
Monica.
about optimizing. And he can do any research he wants to do. He just doesn't care about optimizing and choosing the perfect parameters as much as just having an approach that is maybe enters and exits using parameters that haven't been that great in the past. I think that's sort of the key is getting, number one, you can't miss these big trends. And so back in the day, filter was a bad word. We didn't want to have a filter because all it meant to us was you were going to filter yourself out of a big trend. Entries are very important. In some respects, the entry is more important than the exit because the entry, you've got to do the entry. I mean, that's just the bottom line. If you don't do it, then it's a type 2 era and you have nothing to protect yourself. If you have a type 1 era, a bad trade, you're going to take a small loss. You got that covered, but there's nothing. If Bitcoin is in your portfolio, let's say, then you've got to take that Bitcoin trade every single time the system signals it, because if you don't, you're probably going to choose the time you're going to miss a big trend. So nothing more important than following that system and having a system and doing each and every trade, the absolute most important thing.
I was telling this associate of mine that was we were discussing Bitcoin, and he was kind of asking what should my exit strategy be in? What should my exit strategy be? And I said, well, imagine a peak. And I said, I'm not trying to give you some system right now, but I said, imagine a peak, and maybe you come off 20 or 30% off that peak, then you got to get out. And you could watch his face as I said that. It was kind of like you could see the wheels turning. The wheels turning where, hold on, if I get out 20 or 30% down from the peak, what happens if it goes back up? Right? You can see the wheels turning, right?
Oh, that's hilarious. I did remember asking Rich, during the turtle class, during one of the coffee breaks, like, what is the biggest mistake we're going to make? And he said, not getting back in. You just got to get back in. So you take the small loss, or you got to get back in, and then got to get back in at new highs. Oh my gosh, new highs. Got to wait for new highs? That sounds crazy. Or, you get out prematurely, or not even prematurely. If you follow your system and you exit when it closes below 200-day moving average, if it goes back up, you got to get back in. Wow, there's your Kahneman, there's your human nature. That's difficult to do. I got to get right back in the same market. This market has it out for me. I've lost 5-10 times in a row. Certainly can't have to get back in. I'm going to nuance this a little bit. I'll buy the break. I'll make sure it goes up, and then when it comes down a little bit, I'll buy it there. That'll make me feel better. So a lot of things haven't changed, and they never will change. But it doesn't mean the CTAs can't screw it up by selling 50,000 S&Ps on the open to vol target their portfolio August of 2015. So I don't know if that happened or what happened, but that was unresolved as to, and it's really a black mark on our whole business is what the hell's going on when these vol targeting trades hit the markets in quantities and size, whether it's probably the bid is pretty low and it's really a bad time to be trading large. Sorry to keep harping on that.
No, I think the point being there, and I'm going to bring it back to something you just said about Rich, though, too. The point being with the vol targeting is that, okay, this strategy, some firm might think this particular strategy is working for them in the short term while we're in the middle of this massive U.S. equity boom. The markets seem to generally have a way of neutralizing bad behavior over time.
Yes. Okay. I'm down with that. I just hope that I will get neutralized out of business. So, yeah.
When you were talking about Rich, though, maybe things like the idea of buying those new highs.
11 minutes.
As kids, or as young adults, or your first house, everybody wants to go to the yard sale and get it on the cheap. When you buy your first car, you want to negotiate for the best price. You want to have, when you buy the first house, you want to keep dickering down to get the lowest price you could possibly get. It's the exact opposite of what you should be doing when you're trading.
And I think some of those situations, that's the right thing to do. Definitely dicker down on your house and get it as cheap as possible. But trading liquid markets in a portfolio of all the different asset classes and different markets and time zones and countries, long and short, if you want to pull money out of that market, then I think, what we do is really good. And it's pretty sure my guess would be that everybody who's been in the business for